Thank you for joining this week's Rolling Trades podcast. I'm Dan Pavilonis, and today we will be talking about the crude oil markets, specifically WTI. And I want to just rewind back a little bit and go over some of the things that we talked about in my last podcast. We were talking about the market being uh, uh, at equilibrium in terms of supply, OPEC coming out and raising production by 411,000 barrels, and also the demand structure going into the seasonality of demand here in the US. We go through the driving season. And also as we go through the driving season, looking at the inflation structure and looking at the price of crude oil, WTI specifically, and the 10-year yield and how this all ties in together. And so we looked at the correlation between the 10-year yield and WTI. Crude oil starts moving up. It's heavily weighted in the inflation numbers, the data that comes out in the US. And so if inflation starts ticking up, we start to look at the 10-year yield start to tick up. And so they are kind of tied together. And also the reason why they're tied together is because the crude oil, the energy markets that we trade, the futures markets, WTI again specifically, is about a $1 trillion market in physical, right? But the paper that's tied to that 1 trillion estimate on the physical side is about 6 trillion in paper. There's so many other knock-on derivatives that are tied to the price of oil, right? So because these are all financialized products and in overly financialized products, everything is tied to a yield, right? And it's almost like loan structures. So the 10-year yield is very important here. So we start to see all this stuff. We start to see the equilibrium. The market goes from $55 up to $65 and just kind of pauses right there. And now we go into what happened last weekend. We see an escalation with Iran and Israel. And Iran starts bombing Israel, or Israel starts bombing Iran, and then it's all this back and forth. And the price of oil starts to take off. It goes the front month of July goes up to $77, almost a $10 move in a matter of 24 hours. The biggest culprit of this move was the Straits of Hormuz. There's a ton of oil that goes through the Straits, and Iran controls this area. And so we have that with the possibility of, overthrowing the Iranian government. And what are the repercussions of that? There's anything from, I guess on one end of the spectrum, it would be, any kind of nuclear aspects of nuclear kinetic warfare to just blowing up the Straits of Hormuz, stopping all the oil going through there, and the possibility of oil spiking up to $120, $130 a barrel. As all this stuff's going on, the U.S. administration was going through negotiations with Iran, and then this kinetic warfare starts to happen with Israel and Iran, and then those negotiations kind of step back. Iran steps forward is against any further negotiations, which is completely understandable. But as time goes on, we start to see the targeted impact of Israel hitting Iran, hitting specific targeted areas, and just basically closing in on Khamenei, the current government in Iran. And I think what the market started to focus on is what can Iran actually do now? And then we fast forward even further to today, we see bunker busters starting to hit the or deep impact. I'm not 100% sure they were bunker busters, but where uh Iranian government is supposedly hiding out, and also their intelligence apparatus. And so that was bombed this morning, and then we see Khamenei coming out with asking for negotiations with the Trump administration. So how does that impact oil prices? Oil throughout this whole situation, the targeted impacts, the missiles going back and forth between Israel and Iran has not affected any of the oil trade. In fact, more oil has come out of the Straits of Hormuz this whole time. And At the same time of all this stuff's going out, we saw in today's inventory, yesterday's EIA number that came out after hours at 3:30, and then today's DOE numbers, Department of Energy numbers, that there was major drawdowns in inventory. What this typically would mean is it would be a situation that's very bullish for oil, but oil prices are already elevated because of the war premium. And this just tells me that the anticipation of higher oil prices or the probability of higher oil prices caused a lot of these producers and consumers, whether it's gas stations, whatever, tanks, whatever they need to fill up. These buyers went out ahead of this as soon as they heard the news and they rushed out to the market to purchase. So now we see a major drawdown in inventories. What are we going to see over the next couple of weeks? Well, we could see through the data that's come out through the EIA that they're saying that demand is pretty stagnant right now. We can see through the economic data that's been coming out over the last couple of days that the economy's humming along. It's not doing great. We're not seeing inflationary data where there's major purchases with the anticipation of prices are probably going to go higher because of inflation. We're seeing, airline JetBlue came out and said that ticket demand is down. What does that tell us? Maybe people aren't traveling as much throughout the country. Maybe they're just driving more. This is a season for it. But there's nothing that really checks the boxes right now that would push, I think, would push the market higher. I think fair value is probably $60. And I think now, if we start to see the market anticipate some type of an agreement between Iran, Israel, maybe a new form of the Abraham Accords, setting up a central trading group within the Middle East, whatever it may be, even if it's a regime overthrow, maybe Khamenei's out and there's another guy that takes over. Oil is still flowing. I think we see an overcorrection to the downside. This is my anticipation is all the data, all the bad data, all of the bad things that can possibly happen have already happened and has drawn the market up to 77 at the high. We haven't even gotten higher than the $90 level that we saw back in April of last year when Iran and Israel were going at it. This just tells me today the market's weaker. It's the pricing is weaker. We see the whole curve going all the way out into the later months in crude oil kind of flatten out. So I mean we're pretty fair valued right now in the front months. And so what happens over the next couple of weeks? And my best guess is that there is some type of an agreement. You have an administration, the Trump administration, that works closely with maybe Saudi Arabia, US producers to try to bring down the price of oil. Bringing down the price of oil, again, is tied to the yield, the 10-year yield. You want interest rates to go down. Trump has already talked about Powell needs to lower interest rates. These are the building blocks of lowering those interest rates, getting a commodity like crude oil down. Enough to meet demand, enough to make energy producers happy, enough to make OPEC happy. Where is that value? I think it's somewhere around $60, maybe 63, below 65, above 60, somewhere around there. And right now, we're trading at $72. The high again was 77.62, and I think we got some downside here. Conversely, if things start to heat up again in the Middle East, if there is, Straits of Hormuz gets blown up, which I think is probably outlandish, but if that is to happen, that could cause oil prices to shoot up to 120, 130. There was a note from I think it was like Morgan Stanley that came out that's what they were anticipating. $70 is kind of where we're at right now. And if you look back at the charts over the last couple of years, really that's where we've been hanging out. I mean, we did see a pop up to 70 or a pop up to 90 back in last April when this kind of stuff was going on. Then we overshot to the downside. That's the thing about commodities. We overshoot both ways, right? And so I think we overshot this way. If things start to kind of even out a little bit, I think we'll overshoot to the downside, which I think would be a great buying opportunity. Again, I feel like WTI probably fair value is somewhere around 63, $62. Um, a part of this rally too could have been the anticipation. And this is what I was talking about in my last podcast. In the beginning of the year, the economic data and the expectations was that the US was going to see and go through a recession, right? And so what happens with a recession is you see less energy demand, less oil demand, less jet fuel, so on and so forth. So the market was heavily short. The managed money was heavily short. And the market started to tick up higher because, maybe we weren't going to go through a recession. We start to see the market move up to 65 from 55 over the last couple of months. And then the Israel Iran situation happened, shot the market all the way up to 77. That shoot up to 77, a large part of that could have been a short cover rally, right? And so now if things start to settle out, do you start to see those shorts come back into the market? Do you start to see the algos start to get short again? Do you start to see a lot of the market participants that are just getting in now, not really privy to what's the fundamentals, what's the news? These guys are just headline driven. There's a lot of inventory that bought the market at above 72, maybe 75, maybe even all the way at the highs at 77. If the market starts to turn, you're going to see a big cover on that side too. Those guys are going to be getting stopped out. You're going to be seeing a lot of pockets of stops, sell orders start to hit the market, and then again, that would cause the market to overcorrect to the downside. Could we see 57? I think we're going to be somewhere around $60 to the downside over the next couple of weeks. I'm looking at how to position for that through options on futures, but also understanding that there could be a possibility that we do see a run up to 130. I think the odds are about 70-30 right now. I mean, we're hanging around 70, but 70 in terms of price on futures, 71.87 currently right now. But I think the odds that we're going to come down to 60 or at least get close to it are about 70%. I think a re-escalation of the Middle East, the negotiations don't pan out with the U.S. and Iran, we could see further escalation and the market move higher. So right now, you just have to play very cautious. If you're in the market and you see these swings, news headline swings, I'd be quick to get out, quick to just kind of rein in some risk controls, maybe reduce position sizing, so on and so forth. So um, that is kind of what I'm looking at. I think the big picture here is de-escalation in the Middle East. If there is some type of agreement, and now looking forward at inventories going out over the next couple of weeks. So we see again today's drawdowns, last night's drawdowns with inventories, and I think that's all just a big part of the market. Buyers rushing in ahead of that to buy inventory with the expectation that this thing can kind of spin out of control. The other side of that is Trump is a tactician when it comes to negotiations. So maybe he wants things to be extremely bad. It's a similar MO to the tariff negotiations. And then you kind of walk back and things kind of ease out. We saw the stock market rally exponentially a few times after negotiations, some kind of quasi agreement, which wasn't even really a major agreement, but the market takes off. And I think you'll see the opposite with energy products. So with that being said, I'm going to end the podcast right here and thank you for joining us with this week's Rolling Trades podcast. Again, my name is Dan Pavilonis, and you can reach me at DPAV as in Victor, ILONIS at RJOFutures.com, or you can also reach me by phone, 800-826-1120. And if you want to learn more about trading with us, visit RJO Futures, and thank you again for joining us today. Have a great day.
The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance, whether actual or indicated by simulated historical tests of strategies, is not indicative of future results.